Hey everyone, Ed Conarchy. Welcome back to Conarchy's Money Corner. In this Conarchy's Money Corner, I want to talk about the similarities between gas prices at the pump and mortgage interest rates. Now, you fill up a lot more than you go get a mortgage. Maybe you're filling up once a week, maybe you're filling up once every other week, but you've got gas prices down pretty good because you do it much more often. So, I think it's important that if we can use the analogy of gas prices, it's going to help you better understand mortgage interest rates. Now, one thing that you may not realize is that gas prices and mortgage interest rates are both commodities. Do you know this? Do you know that those prices are determined by the activity in the markets, just like stocks trade every day, minute by minute? Bonds, mortgage-backed securities, which determine the price of mortgage rates, and crude oil, which determines the price of gasoline prices, are trading every day, minute by minute, tick by tick. And that velocity, that volatility that's happening is then determining the price you see at the pump or you see from your mortgage company getting a mortgage interest rate. So what we have to realize is that we all are dealing with the same thing here. Gas companies are selling gas, mortgage companies are selling mortgages, and those prices are determined for all of us with one source. Now, because of this, if you were to see two competing mortgage companies, or in our example, two competing gas stations at the same corner, we tend to always see that they're going to be generally very close in price. Otherwise, they're going out of business, right? Because they're selling a commodity. The same can be said about the mortgage industry. So in this example, if one gas station lowers the price of their gasoline, the other will be forced to do the same to keep it similar. Now, they could be a penny or two different, and one may have a little bit more frill here than the other one, but they're going to be very similar in price. Now, if one raises, the other one most likely will too. So that whatever the market's driving is driving that prices. Now, here's the thing though. If there is big differences, chances are there's a catch, and your red flag better go up. That if you talk to one mortgage company and get something and it's a very big difference talking to the other mortgage company, you've got to dive deeper. And here's the greatest example of that. So going back to the gasoline, you drive by and you see one gasoline at gas station at one corner has a price of $2.49, big bold numbers, $2.49 and 9/10. That's a whole nother story. We have to do a video on that whole 9/10 thing sometime. So big $2.49, right? And then the one across the street is at $2.69, and you're like, yeah, that's the one, and you pull in, you go to the pump and actually see it's $2.69, just like the other one, that the only way you're going to get $2.49 is, what's the fine print? You know what I'm going to say here, with a car wash, right? So how many times do we get fooled by the headline only to find out the fine print is the catch? And that's what we have to understand. I mean, take that example. $2.49, that's 20 cents cheaper. You pull into it only to find out the only way you're going to save the 20 cents is if you buy a car wash. So say you have 20 gallons of gas you're putting in. Yeah, you'll save the 20 cents, which is $4, but you have to pay the $10 car wash. You actually lost $6 for that lower interest rate. Oops, that lower gas price. See how those are synonymous with one another? So that's the biggest thing. What I'm finding is that interest rate will get you in trouble if you only focus on that. You have to focus on lender fees. That's the catch. That's the big catch in our industry, just like the car wash is the catch in the gasoline industry. Now, the thing to understand about mortgages is that one will affect the other, okay? So think of a teeter-totter as we're balanced here. And on one side is interest rates, and on the other side are lender fees. What you have to understand, like a teeter-totter, if we lower one side, the other side is going to go higher, and vice versa. So if you find a company out there with a low interest rate, no doubt they have higher upfront, non-refundable, non-tax deductible lender fees. And vice versa. If you tend to find another company that has a higher interest rate, then at that point they most undoubtedly have lower upfront, non-refundable, non-tax deductible lender fees. So what you have to do is you can't fall victim of the headline. You have to read the whole story. The headline is the interest rate, the whole story are the fees. So what we have to do is we have to do our homework and not just focus on interest rate. Now this is hard for your brain to do this because as a consumer you think you know interest rates because of math when you figured out 4.875 was less than 5%. Now what you have to understand though is that's one piece of the puzzle, and hopefully I'm illustrating it here. That's the rate. The next question has to be the fees. Now, I am not a big fan of upfront fees because they're upfront, non-refundable, and non-tax deductible. That's why I'm much more biased on saying, yes, the interest rate's important, but the upfront fees you pay today that will never be seen again because they're non-refundable may be even more important than the interest rate. Now, I'll leave you with one last gas analogy. There's a big difference, though, in the advantage of mortgage interest rates over gas. And it's this. If you pulled in and you filled up at that 269 and you drive by 2 days later and see that it fell to 253, you can't change anything, right? You can't go into that gas station and say, suck the 269 gas out and replace it with the new 259 and give me my change back. No, it doesn't work. Do you know that gas stations don't take returns? Yeah, they won't take your old gas back. You're stuck with that price. Well, I'm here to tell you that mortgages are the only financial instrument that lets you do a do-over. So no matter what you get on your interest rate, after closing, if you find out there are lower interest rates, there's no problem. You can always refinance. That's why we tell all of our clients to always lock into their interest rate, because if you lock into your rate and rates go up, you're happy. And if rates go down, you can always refinance. So I hope I did a good job here of an analogy of comparing you what you do a lot more often, filling up your gas tank with getting a mortgage to help you understand how they're actually very similar. Hope you enjoyed this Conner Keys Money Corner. Talk to you next time on Conner Keys Money Corner.